Hey there, everybody. How you doing? I hear you asking, what is option trading? What does it include? And where do I start? Right? I got you. I got an answer for you. In this video, I'm going to give you the types of options trading, and I'm going to tell you the 5 strategies that can be used as an options trader. Let's get going. With options trading, you can either buy or sell. You got 2 sides of that coin. You can buy calls, puts, and debit spreads, or you can sell calls, puts, and credit spreads. If you're buying options, you can buy calls, which is a bullish trade, believing prices are going to go up. If you're buying puts, that's a bearish trade, believing that the price is going to go down. When you do call debit spreads, that's also bullish, believing price will go up, just will cost you a little bit less money than just calls outright. And if you do put debit spreads, that's a bearish trade, believing price will go down. It's going to cost you a little bit less than doing straight puts. If you're selling options, you're selling covered calls or what's called naked calls sometimes. That is a bearish or a neutral strategy, right? If you're thinking prices are going down or they're just going to sit still and consolidate, this is when you would incorporate covered calls. If you're talking about cash secure puts, it's another selling option. It's bullish or neutral, believing price will go up or will consolidate. This is a bullish, opposite from buying puts, which is bearish. When you're selling puts, you're bullish. You can also sell call credit spreads, which is also a bearish or a neutral strategy. And you can do put credit spreads, which is a bullish or a neutral strategy. There's 5 time frames that I'm going to talk about that you can use this buying and selling strategies in. I'm going to talk about them both on each slide. We're going to talk about scalping, day trading, swing trading, either the 1 or 2 days or doing the weekly. We're going to talk about monthly trades and talk about leaps. So if we're talking about scalping, we're talking about entering trades for very short periods of time. Maybe you know exactly what kind of pop or what kind of drop you want to get, a very short trade. You're going to just get in for a few dollars, a few movements of the price. That's going to be kind of a quick trade, right? You're looking for small pops or drops in the price. It's extremely high risk and it requires very close monitoring. So scalping can be done as a buyer or a seller. All the strategies I'm going to talk about can be done as a buyer or a seller, right? If you're scalping as a buyer, you're going to enter the trade, buy a call or a put option, let it do what you're expecting it to do, and then you're going to close it as quick as possible. Scalping can be 5 minutes, it can be 2 minutes, it can be 15. Generally, you're just doing a very short period of time. If you're selling as a scalper, you're doing the same thing. You're expecting to enter into your trade, take in your premiums, and then close it up when it's done, when it's made a few dollars. Now, if you're selling, this is a key piece of information. You need to make sure that you're opening and closing in your margin account, and you need to have at least $25,000 in that account. Otherwise, you're going to run into pattern day trader issues. That's a whole nother video, and if you check my channel, you'll be able to see that there's some conversations I have about pattern day trading. You want to make sure that if you're scalping as a seller, you need to have at least $25,000 in your account. Let's move on to day trading. Day trading means that you're opening and closing the trade the same day. It could be I open it in the morning and I close it in the afternoon. It could be an hour, could be a couple of hours. It really could be, it's called day trade because you open and close it each day. You can also do this as a buyer and a seller. This one's basically used when you're looking to hit your profit targets. Maybe you say, I want to see if I can make another $25, $30, $50, $100, $500 off a particular trade. You're looking at profit targets when you're doing day trading usually. It can be high risk, right? Day trading can be high risk, especially if you're doing 0 DTE options. Now, this is where a big difference between buying and selling comes in. If you're buying options and you're doing that just for 0 DTE, which means it's going to expire today, then you need to be mindful of the fact that theta decay is working against your trade, right? Theta decay is chewing up your premiums, if you want to call it that. That makes it very high risk, and you have to watch the timeliness of your entry and your exits. You can't let the money day trade of options continue to go up till expiration. You could really run into problems with your premiums and your profits getting eaten up. On the other hand, If you're a seller, we like theta decay as a seller. And you can do zero DTE options. Actually, it could work out really good in your favor because theta is now working to help you with your trade. So if you're selling as a day trader, again, you got to keep in mind about the pattern day trader piece. But if you allow the trades to expire worthless, then you won't be charged a day trade for that. I do want to caution you, though, that in some cases, like Robinhood and some of the other brokers, Thinkorswim, some of the others, they may close your trade for you if they do a risk assessment and deem that your trade is too close to in the money. They may shut it off and then they will charge you a day trade. So you want to be mindful of that. One of the ways we get around that, though, is we trade cash settled entities like XSP, SPX, RUT, DIA. We trade some of the ones, and I always struggle with the DIA or DJIA. Anyway, I know we trade XSP and SPX because those are cash settled. Day trading, though, requires a lot more monitoring because you are basically exposed to the movements of that particular stock price throughout the day. So you do want to be very mindful of the fact that day trading can be highly risky. Well, hey, I created a resource, the Zero DTE Strategy Cheat Code, because all of us did a little cheat sheet when fooling around with this Zero DTE stuff, all right? This PDF is going to give you the 5 quick and easy steps to 10% profits every day. Basically, you're using the Zero DTE stocks in order to capitalize and generate profits on a daily basis. Go ahead and download it. I'll give you a link in the description, and you can have your copy and be going through that right now. All right, thanks. The third options trading strategy is swing trading. You can swing trade 1 to 2 days. Maybe you enter today and you have the plan to exit tomorrow. That's called a swing trade. Or you enter a trade with the plan to exit in a day or two. Right? That's called swing trade. You're basically swinging it overnight, right? This won't have you exposed to any of the day trader rules or any of the day trader issues that you run into because you're carrying it overnight. That's not a day trade. Have to open and close the same day for a day trade. Basically, with swing trading, you're opening one day and closing on a subsequent day. Also, this is used for profit targets. You can do this as a buyer or a seller. Both of these work. It's moderate or high risk. And what you run into, the risk area, is primarily based around overnight gaps or pre-market gaps. Sometimes the price has something happen overnight, something happen in the pre-market, whether that's earnings or life or news happens, and that can make your stock price gap up or gap down. Now, if you're going, like, let's say, for example, you're buying calls and the price gaps up, then yes, so wonderful. But what if you're buying calls and the price gaps down? Not so wonderful. And you cannot trade options after the market is closed. So whatever happens in the post-market and pre-market, if you're working with options, you basically have to wait till the market opens in order to decide or to make some type of move because you can't do anything when the market is closed. But if you're selling now, I was just talking about buying calls and puts. If you're selling options and you're swinging them overnight, again, you're now, theta decay is still helping you, reducing your premium, which is what you want. You want to enter high, you want to sell high and buy low when you're a seller. And a gap up or down could be a benefit to you as far as moving the price of the stock away from your strike price. But it can also work against you if it gaps up or down and into the zone of your trade. So you do want to be mindful of that. That's why it's called moderate to high risk, because if you only have one more day or one day between the entry of your trade and the exit of your trade, you now need to be able to manage the gap up or gap down of the price as soon as the market opens. These do require a little more monitoring, not as much as day trading or scalping, but they also require some monitoring. You can also swing trade on a weekly basis. Perhaps you do one of the things we do, and I'm going to talk about selling first this time. We enter credit spreads, let's say on a Monday, with the plan of them expiring that Friday. So we're going to swing over Monday night, Tuesday night, Wednesday night. Of course, you want to get to the place where either you let your trade expire worthless at the expiration day, which would be that Friday, or you're going to close it when you hit the profit target that you're after, okay? Also, if you're buying, you could also be buying on Monday with an expiration of the Friday or the subsequent Friday or whenever you so choose. That also usually ties back into some profit target that you're working towards. Moderate risk here because you do have a little more time on your side as far as maneuvering your trade. You've got to be able to look at the different movements of the price and seeing if you can adjust in what's going on. You may decide you're going to close it when you hit your profit target. You definitely don't have to wait until expiration to exit any of these trades. I want to make that very clear. You don't have to wait till expiration to exit any trade. As soon as you've reached your price target or your profit target, you are free to close this trade. Weekly trading or weekly swinging requires a little less monitoring than overnight swings and definitely less than day trading and scalping. So, hey, if you want to elevate your learning of credit spreads, I do have a resource, a training resource for vertical credit spreads. I'll put the link down in the description and you can grab that and be able to go a lot deeper into credit spreads and how they are going to help you to generate nice, consistent profits. All right, check the link in the description. The fourth strategy we're going to look at is monthly trading. It's usually tied to the monthly expirations, the third Friday of the month primarily. That's called OPEX day. Basically, that's when the monthlies expire. A lot of people seem to like those days because there is generally a lot of volume that happens. Open interest is on those days. Getting in and out of your trades may not be difficult because there's a lot of volume there that can help you. This is generally used when you have a leaning, but your stock needs the time to reach the price target. Perhaps you say, I believe it's bullish, but it's got an ATR of 1 and I'm looking for it to get $5 or $10 away. That means you need to give it time to make its movement because nothing generally ever moves in one direction completely. It may go up, it pulls back a little bit, goes up some more, it goes down, hopefully pulls back, goes down some more. Generally, stock does not move in a straight line. So you use monthlies when you're thinking you have a good future stock target, but the stock needs the time to get to it. It's not going to get there in the short term. It may take a little longer. You use monthlies there. Our biggest risk with monthlies is the impatience. Ooh, psychology is our biggest thing right here, is the impatience of waiting for it to do its thing. But again, I will say, you can close these trades whenever you're ready. The last one of our option trading strategies we're going to talk about in this video is leaps. Long equity positions, anticipated positions, I think is what the leap stands for. Basically, is long term. Long term. You're looking at expires 6 months in the future, a year in the future. Some people go out even 2 years and 3 years in the future because they want to expose themselves. They want to take benefit of a longer term upshoot, a longer term drop of a stock they believe is going to, rise over the longer term or drop over the longer term. Some people really like to use SPY for this, or some maybe VOO, some of the other ETFs that seem to be very popular in this area. Or if you know there's a stock you really like and it's just got to get out of the gates really good, it may be a small stock at this point, but they have great potential. You may decide you want to buy a long call that you want to buy out 6 months, 8 months, 9 months, a year from now, giving it the time to do its move. Some people also use leaps as a way to grow, but they can also use them for covered calls. If you've got a leap and you want to sell a covered calls against it, you can do that. Right? Selling covered calls against the leap is something you can do. It's actually called the poor man's covered call. And I have a video about it on my channel if you'd like to go find that. Low theta decay happens when you're doing longer term leaps. You don't have to worry about theta being so much of a factor against you from day to day. You don't have to be concerned about that. But what you do have to be concerned about is these can be very expensive as a buyer. If you're buying calls and buying puts out 6 months, 9 months, a year, and 2 years later, you're going to spend a few more dollars than you would if you were just buying it for the week or buying it for the month. Now, for selling, leaps don't usually get used by sellers as much. I'm not saying that it doesn't happen, but it doesn't get used as often because as a seller, you do want the theta decay. You do want theta to decay in a more rapid pace. But where you can get benefit from selling Leaps is that you take in a really good premium. You take in a high premium when you're selling. Just like it costs buyers a lot more to buy them far out, it actually that you take in big premiums when you're selling. You can tie up a lot of collateral that way, but there are people who have a whole strategy that they use to make this work for them.